UK borrowing costs have climbed up to their highest levels since the 2008 financial crisis, driven by stubborn inflation, high interest rates, and rising energy prices, so not exactly a great mix. My name is Jack Rivas and welcome to this week's episode of Tax Tidbits, where in February alone, government borrowing hit £14.3 billion, much higher than expected. Thanks to rising spending and hefty interest payments, it's basically like a very expensive national credit card. Despite increased income from taxes, it's still not enough to ease the pressure, and with debt sitting at around 93% of the economy, the government doesn't have much wiggle room left. All of this raises big questions about what support, if any, can be offered on energy bills. Speaking on energy bill support, Chancellor Rachel Reeves said this week that the government is getting a plan ready in case energy prices spike again due to ongoing global tensions that are affecting the supply. However, any help will be aimed at those who need it most, meaning not everyone will get a slice of the pie. While bills are set to dip slightly from April, they're expected to bounce back up in the summer as global energy markets stay unsettled, so the pressure on households isn't going anywhere anytime soon. However, with tight borrowing rules and concerns about inflation and interest rates, the government's options are limited. So unlike 2022's all-you-can-eat support package, this one's looking more like it might be a more carefully rationed meal. On top of that, the government is also looking at tougher action against any potential profiteering by energy and fuel companies in an aim to keep bills down. UK inflation remains steady at 3% in February, so there weren't any major shocks, but no cause for celebration either. Global prices pushed things up slightly, while cheaper petrol and alcohol helped balance the scales, though this was all measured before the Iran conflict, which has since thrown a bit of a spanner in the works. Although inflation has come down from its peak, prices are still rising, just at a slower pace, and with oil prices now rising again, costs like fuel, energy, and everyday essentials are expected to follow. The ripple effects are already being felt across the economy, with businesses warning of rising costs and potential cutbacks, while analysis suggests inflation could rise further this year, meaning interest rate cuts might be off the table for now. A payroll company, Omnia Outsourcing, has been named among nearly 400 UK employers caught underpaying staff below the minimum wage, so probably not the kind of firm you'd want managing your paycheck. The company was found to owe over £8,000 to 14 employees, and in total more than £7.3 million is owed to around 60,000 workers across the UK, with some big names like Costa, Bupa and Hayes Travel also on the naughty list. While the majority of businesses are following the rules, it's a clear reminder that the minimum in minimum wage isn't just a suggestion. The government is urging employers to double check their payrolls to make sure staff are being paid properly before things get messy. With minimum wage set to rise in April, the pressure for employers to get it right is only increasing. So if you're unsure, it's definitely worth getting some help before mistakes get expensive. This week, the government has announced that it wants to make more of its own steel, about 50% rather than 30%, instead of relying so heavily on imports. To help achieve this, it's bringing in tougher rules from July, including cutting import quotas and slapping a 50% tariff on any steel brought in above these limits. The goal is to protect the UK steel industry from cheaper foreign competition, which has been a problem due to high energy prices and global overproduction. While the steel sector and unions have largely welcomed the move, some critics warn it could raise costs for UK manufacturers and put more of a brake on economic growth. The government insists that the policy is not about stopping imports, but about levelling the playing field, although there's no clear timeline for when the 50% target may actually be reached. That's it for this week's Tax Tidbits. If you found this helpful, make sure to like, subscribe, and stick around for next week's update, where we'll break down the latest in tax and finance without the jargon. And as always, if you've got any questions or topics you'd like covered, drop them in the comments.